The world of finance. Well, it often feels pretty remote complex, right? But sometimes, even the parts you think are rock solid start to show some cracks.
Mm-hmm.
So today, we're taking a deep dive into something usually seen as, the bedrock, the U.S. bond market. And, well, according to the material we're looking at, there are some serious tremors being felt.
That's right. Our source for this is an article by Andre Jikh. It's called "The Collapse of the Bond Market is Happening Now." And yeah, it lays out a really compelling data-driven case that things are under immense strain, economic pressures are really escalating.
So our mission here, for you listening, is to really unpack that case. We're working through the source material you gave us.
Exactly.
We want to pull out the main argument, look at the key warning signs it mentions, understand the deep forces driving this, and the potential implications in the piece. Basically help you cut through the noise.
Yeah, see what's really important here. Because, I mean, the health of the U.S. bond market isn't just some abstract thing, is it?
No, definitely not.
It touches everything. The government funding itself, the interest rate you might pay on a mortgage, a business loan. It's incredibly relevant.
Okay, let's get into it then. The central thesis here is, well, it's pretty stark.
It is.
It argues the bond market isn't just hitting some turbulence, it's facing immense pressure from like two massive things: national debt and rapidly rising interest rates.
And crucially, it suggests this signals a structural issue, not just a temporary blip, with potentially global consequences.
Right, and the author points to some really striking facts as warning signs.
Yeah, one just jumps right out at you. The scale of the debt payments. The U.S. government is now spending more money just paying the interest on its debt
Wow.
than it spends on the entire national defense budget.
Just the interest, that really puts the size of the debt itself into perspective, doesn't it?
It really does.
The article also notes, some big names are sounding the alarm. It mentions Jamie Dimon, CEO of J.P. Morgan Chase. Apparently, he's warned regulators about a potential, imminent bond market crash.
Yeah, and it's not just a U.S.-centric worry either. The piece brings in that global view, pointing to Japan's 30-year bonds. Their value dropped significantly, something like 45%.
Okay, so that suggests these pressures.
Hmm.
They're not totally isolated. There are broader forces hitting government debt markets.
Seems that way.
So, okay, let's back up a second. Why does this market matter so much to you? Whether you're deep in finance or, just managing your household budget.
Well, basically, bonds are just government IOUs. When you buy one, you're lending the government money for a set time, and they promise to pay you interest. Simple as that, really.
Right. Loaning the government money.
And the key thing right now, the really crucial dynamic, is how bond prices and their yields, the interest rate they pay, move. They move inversely.
Inversely, okay.
So if demand for bonds falls, maybe investors are worried, their price drops. And when the price drops, the effective interest rate, the yield, goes up for anyone buying that bond.
And the article gives a pretty dramatic recent example. The U.S. 10-year Treasury yield. It went from less than 1% back in 2020 to around 5% in 2024. The author says that's the fastest jump in, 40 years?
40 years, yeah. A huge, rapid increase.
So what does that mean in the real world?
Higher yields mean higher borrowing costs. Simple as that. For the government, obviously, but it trickles down.
Right down to us.
Directly to businesses needing loans and, yeah, critically, to consumers like you. We're talking higher rates on mortgages, car loans, potentially even credit cards down the line.
Okay, so if the market's under this kind of pressure, what's actually driving it? The article suggests it's more than just the usual market ups and downs.
Exactly. A big part of it seems to be faltering investor confidence.
How so?
Well, think about it. If you're lending money to the U.S. government maybe for 10 years, 30 years, and you start having doubts about their long-term ability to manage their finances, to repay that debt eventually.
You'd want more compensation for the risk.
Precisely. You're going to demand a higher return, a higher yield for taking on what you perceive as increased risk. And that demand for higher returns is what pushes yields up and bond prices down. It's a red flag, really, a signal of potential economic distress.
And the article mentions it draws heavily on the work of Lynn Alden, her broken money framework.
That's right. Yeah, it uses her analysis as kind of the intellectual backbone to explain these structural problems. Her core idea is that certain fundamental aspects of how our modern money systems work are flawed, and they lead to these persistent issues like structural debt.
Okay, so what are the key points from her work that the article highlights?
Well, one big one is this reversal of historical trends. Normally, right, when the economy's strong, unemployment's low, You'd expect government deficits to shrink, governments collect more taxes, pay out less in support.
Makes sense.
But the article points out, using Alden's analysis, that since around 2017, deficits have actually grown, even during times of low unemployment.
Huh. So the borrowing isn't just happening during recessions.
Exactly. That suggests it's structural. It's kind of baked into the system now, regardless of whether the economy is doing well or poorly. Constant overborrowing.
Okay, what else from her framework?
Another key idea is negative real interest rates. This is a bit technical, but important. For years, the article explains, the interest paid on bonds, the nominal rate hasn't actually kept up with inflation.
So after inflation, your return is tiny or even negative.
Right. The real interest rate, that's the interest rate minus inflation, has been near zero or sometimes negative.
And why hold something that loses purchasing power?
Precisely the question investors ask. The article argues this environment pushes investors away from traditional safe havens like government bonds. They start looking elsewhere, maybe gold, Bitcoin, real estate, things that might hold value better against inflation. It weakens demand for bonds.
Got it. And there was a third point mentioned.
Yeah, about public versus private debt. The article highlights, again drawing on Alden, how government borrowing, public debt, has really outpaced private sector debt growth since the 2008 crisis.
So the government's been the main driver of overall debt expansion.
Pretty much, even during periods when the private sector was actually trying to reduce its debt or wasn't borrowing much. This shift, the article argues, kind of undermines long-term confidence. It suggests the government's financial management is the issue, not necessarily productive private investment driving debt.
The article apparently uses some charts to really drive these points home visually.
Yeah, absolutely. They make the data much clearer. There's one showing that disconnect. We talked about unemployment staying low, but the deficit continuing to grow after 2017 really shows that structural borrowing pattern.
Okay. What other charts?
Another important one tracks gold prices against real interest rates. You can sort of see this divergence where, as real rates on bonds became less attractive, investors seem to have moved towards assets like gold. It visually backs up that argument about shifting preferences.
Right, the move away from bonds when real returns are poor.
Then there's the chart comparing public versus private debt growth. It just clearly shows how government borrowing really took the lead, becoming the main engine of debt expansion in the economy.
And probably the most critical one.
Yeah, I'd say the one overlaying the debt to GDP ratio with interest rates. It's pretty stark. It shows the U.S. currently sitting at record debt levels over 120% of its entire annual economic output, its GDP.
Which is massive.
Huge. And at the same time, the interest rates on that debt are climbing rapidly.
And that combination.
Yeah.
That's the core problem.
This is the dilemma the article really hammers home. When you have such an absolutely enormous pile of debt, even seemingly moderate increases in the interest rate you have to pay on it become incredibly expensive. Astronomically expensive. You're paying interest on trillions and trillions.
Right. It's not just the percentage rate, it's the rate times that huge principal.
Exactly. The article uses a great analogy for this. It calls it the debt trap.
Oh, yeah.
It compares it to, like, grandpa bragging about buying a house with 15% interest, but grandpa forgets or doesn't mention that the house itself only cost, the equivalent of 2 raspberries back then.
That's a perfect analogy. Gets right through it.
Doesn't it?
It's not about whether today's percentage rate is higher than the 80s. The point is the absolute amount of debt is vastly, vastly higher.
Exactly. So refinancing that debt or issuing new debt to cover deficits, even at 4% or 5%, it costs exponentially more in actual dollars than refinancing a much smaller total debt did back when rates were, say, 10% or 15%.
Okay, that makes the danger really clear. Now, the source also mentioned another major structural reason for all this government borrowing, something about Social Security.
Yes, that's identified as a key driver. The article includes a chart it dramatically calls the Social Security bomb.
Okay, sounds ominous. What does it show?
It basically projects the future. Rising payments going out to retirees as the population ages, the expected depletion of the Social Security Trust Fund.
Which means,
fundamentally, the government has to keep issuing more and more debt year after year just to make good on these existing promises. It's a built-in, long-term, structural demand for more government borrowing. It's not optional.
So it's another source of relentless pressure to issue bonds.
Precisely.
One thing that comes through, besides just the warnings, is how educational the article tries to be.
Absolutely. The author, Jikh, really frames this whole situation as kind of a real-time macroeconomics lesson.
Yeah.
Yeah, he uses it to explain bond dynamics, that crucial difference between nominal and real interest rates we talked about, the whole idea of structural versus cyclical debt, even how global investor psychology factors in.
So it's not just the sky is falling, it's explaining why this combination of high debt and rising rates is such a fundamental threat,
Yeah.
using what's happening right now to teach these, honestly, quite complex ideas.
Exactly. It adds a layer of understanding beyond just the headlines.
And finally, did the article offer any takeaways for investors, or mention the author's own strategy?
It did touch on that. It suggests considering alternative investments that might hold up better in this kind of environment. Specifically mentions scarce assets, things like gold and Bitcoin. Also, some defensive stock positioning.
Okay, anything else?
Yeah, a key piece of advice highlighted was the need to step back and watch the big picture, the macroeconomic indicators, not just get lost in the daily noise of stock charts.
Because the fundamentals are being tested.
Right. The author emphasizes that the very foundation of global finance is facing some serious tests, so you need that broader perspective. He also briefly mentions he personally uses platforms like Moomoo to keep track of these broader economic themes and data points.
Okay, so let's recap this deep dive then. We've walked through the source material you provided, looking at the signs of stress in the U.S. bond market.
The warning signs.
Explored those deep-seated structural drivers. The article points to like the massive debt growth, the shifting investor behavior thanks to inflation, those baked-in obligations like Social Security.
And the real-world impacts, like higher borrowing costs for everyone.
Right. Our goal here was really to distill all that complex information from the article into some clear, data-driven insights for you, trying to capture the balance the author struck between, the stark warnings and the actual educational value.
Hopefully making sense of a pretty complicated and frankly concerning picture.
So here's a final thought maybe for you to chew on. Building on this whole tangled web of structural debt, interest rates, and future stability that the article laid out.
Okay.
As governments, not just the U.S. maybe, face this ongoing, almost structural need to issue huge amounts of debt just to fund things they've already promised, like Social Security. How might that fundamentally change the power dynamic? The relationship between those governments and the global lenders, the investors who buy their bonds.
Interesting question, the balance of power.
Yeah. And what could that shift eventually imply, maybe way down the line, for the very nature of money itself? Something to think about.